Hi everyone, it's Jack back with another video. Today I'm going to be talking about Lockheed Martin. Pretty interesting company, has been a reasonably good company to own over the last 5 years or so, up 75%, not including the dividend payments over that time. It pays about a 2% dividend yield. However, almost half that gain is since the turn of the year, up 32.68% since the 31st of December. Really interesting. Investors are obviously seeking safety in times of inflation, and defence stocks are a classic example of this. They have very long backlogs. In Lockheed Martin's case, it's a $135 billion backlog, which is 2 times its revenue. The obviously more tangible reason is that war pays for defence companies, and the risk of a world war is non-zero at the minute. During the Ukraine crisis, I want to establish whether it is still reasonably valued and therefore investable at these prices after a serious run-up. Looking at some balance sheet metrics on the left-hand side, Lockheed Martin has around $11.6 billion in debt on the balance sheet and about $3.6 billion in cash, for a cash-debt ratio of about 0.3. This is not very strong for an average company going on. The many companies I look at on this channel, that is not a particularly strong cash-debt position. However, it's not actually that bad for this industry. Many defence companies are very acquisitive to go looking for growth elsewhere, and it is a capital-intensive business. That being said, Lockheed Martin isn't that acquisitive, but this debt has been steadily reducing from $15.2 billion in 2015 to $11.6 billion today. So, of course, they could easily pay down this debt. They make about $9 billion in free cash flow every year, but it's well covered by EBITDA, so I'm not particularly concerned about it. Debt to EBITDA of 1.23, very good for Lockheed Martin's history, as you can tell, because that debt is coming down. This is a reasonable number in my opinion. Almond score of 4.45 indicates the company is not at immediate risk of financial default. I would of course like this number to be higher, but for me the balance sheet is not particularly a problem, although not an absolute strength. Interestingly, return on invested capital at the bottom, 17.35%. This is actually very, very strong for the defence industry in my opinion. A very positive metric for this company going forward. Profitability wise, company is actually absolutely excellent for this industry. Operating margin 13.61%. Very, very strong at this scale. Very strong for Lockheed Martin's history and excellent for the defence industry. Net margin of 9.42%. Very strong for the industry. Very good versus Lockheed Martin's overall history. And that's particularly with the vast supply chain challenges this year. So net margin's been compressed a bit. So to maintain it this high, very strong. That's 9.42 cents for every dollar of revenue, which is excellent. Return on assets of 12.29%. Absolutely excellent. Particularly for this industry, return on assets for this industry tends to be a bit lower, and return on equity 80. I'm not sure if that number is exactly right, but return on equity for Lockheed Martin tends to be very high. This is a very strong number. Revenue growth over the last 3 years on average is 8.8%. Not particularly impressive, but this is a very, very mature company. It's been around for a long time, and you're not expecting ridiculous revenue growth from a company like this. Taking a peek at some valuation metrics, price to earnings ratio is of course the most important one here and the most comparable. Price to earnings ratio of 20.6 and a forward PE of 17.7, both below the S&P 500 averages. Defence contractors do not typically carry premium multiples, and this is reflected by this being reasonably priced amongst its peers in the industry, right about the middle. Of course, companies like Boeing, companies that have been struggling recently with more aeronautic side, are dragging this up, but this is a reasonable valuation. It's not great for Lockheed Martin's history because, as I said, it's run up 30% in recent years, so this is a bit elevated. Price free cash flow of 16.85 also looks reasonable, is below the S&P 500 average. Both these are right about the 3-year median for Lockheed Martin. Price to earnings growth ratio of 1.91, not a bargain by any means, but is in the reasonably priced range of 1 to 2 in my opinion, and is again very good versus the historical values for this company. So overall, looking at these metrics, they're not definitive by any means, but it's looking like Lockheed Martin's share price is right about where it has been for a long time, and that 30% run up has just brought it from absolute bargain basement to perhaps reasonably valued. So next up in the fundamentals list is to do a discounted cash flow calculation to calculate the fair value of the business based on the sum of its future cash flows discounted to the present, as we always do. Lockheed Martin has a 10-year average free cash flow growth rate of 16.3%, which for me seems unlikely at the very least. If optimistic at a minimum going forward, looking at the revenue numbers, 6.7% 10-year growth rate, 5 years 9.6, in the last year 3.9. I think this is more in line with what free cash flow will do going forward. They struggle at certain points, cost savings become more difficult to get, and I think free cash flow growth in line with revenue growth is perhaps more sensible. That's why I've used a 7% number, and we'll talk in a minute about what the revenue is going to be doing in recent years and why it's going to be a bit depressed. I believe revenue can grow for the next 10 years on average around 7 to 8%, with free cash flow growth in line with this or slightly above. Inputting this into the calculation at 7% free cash flow growth with an 8% discount rate gives a fair value of $472, or essentially the share price right now. So by my prediction, it's trading at roughly fair value. Looking at the overview of the full year report for 2021, revenue of $67 billion, up only around 3%. They blame supply chain problems here basically, as many companies have. Their future planning, Lockheed have admitted in the short term, revenue and earnings per share growth will be low. This is nothing new. The share price didn't really react to this from the full year because they've spoke about this in the October, the Q3 report. Cash return to shareholders is going to remain strong, $4.1 billion of repurchases, and of course the quarterly dividend. They continue to reinvest in R&D at an impressive rate. All in all, this was a decent year. I expected more on the top line, but with the challenges of 2021, particularly supply chains, I think they did absolutely admirably. Just diving into those numbers a bit more compared with 2020, revenue and operating profit only up slightly as mentioned, about 3%ish in a very challenging year. Maintaining these alone was kind of good enough for me. I did expect more, but as the year evolved, it was very clear that supply chain problems, especially in the nature of this company and the nature of the things it's building, particularly aeronautics, very, very labour intensive, very supply chain intensive. I think this is perfectly fine for this year, and I'm looking forward to what they do going forward. The major concern for Lockheed Martin was what they announced in Q3 is that revenue is predicted to drop. Obviously, this report was pre the war in Ukraine, so perhaps some changes post this, but I doubt there will be a significant difference. Basically, reverting to 2020 numbers. This is not new news, as I said, spoke about in October, setting up for future growth, and they acknowledge this and essentially ask shareholders to hold shares and reap the rewards of cash return rather than revenue growth. As I said, they're repurchasing shares at a good rate, they're paying a dividend, and they're essentially asking Lockheed Martin shareholders to keep hold at fair value and see what happens. But again, this was before a 30% incline in the stock price. As I mentioned, strong cash return, always been strong. 91% of free cash flows returned to shareholders. Dividends are strong at now 2.3%. Share repurchases are of course variable and may not continue due to the recent elevation in the stock price or not at least at the same rate. But cash is being returned to shareholders at a reasonable rate, and I'm really enjoying this. Previously, before this 30% run up, the stock must have been trading at bargain basement numbers, and I can see why the company has had a run up, but it's mainly macroeconomic trends and external factors. The business is absolutely not firing on all cylinders at the minute. Revenue is predicted to decline by $1 billion to $66 billion year over year. This isn't the end of the world for a company of this scale and maturity, especially with this backlog, which is around 2 times revenue, but it's absolutely not ideal. Supply chain challenges are not going away, and there are several headwinds against this company. However, with that being said, they're well positioned to continue to return cash to shareholders, and I believe they're well positioned to be able to pay off on a 7-year revenue growth rate and free cash flow growth rate over the longer term once they get away from these supply chain problems and move on to selling as they normally would. They still have the F-35 Lightning program. They have a lot of potential with space, for example. Cathy Wood actually holds Lockheed Martin in one of her space ETFs. So I believe there's a lot of potential for single-digit growth for this company. And I think it is a wise hold in today's world of heavy inflation with that backlog. This is a company that's going nowhere, relatively safe revenue. So I believe I would be happy to buy at this value. I'm not going to. I would rather wait for a bit of a lower price. I kind of missed the boat on letting it rise 30%. I'll be happy to buy at a higher price, but I'm happy to leave it for now. That being said, none of this is financial advice. If you want financial advice, speak to a registered financial advisor, and of course do your own research and due diligence. With that being said, thanks for watching the video. Please like and subscribe if you want the channel to grow, and I'll see you again.